Okay, I think we'll give it a start now. So good morning, everyone. Good afternoon, everyone, I should say. Thanks very much for joining us today. And yeah, this, the second week of our March ISA event. So for those who attended last Monday's event, this session is a bit more, I suppose, like fireside chat, casual Q&A, as opposed to a lengthy presentation, but equally as interesting, I'm sure it will be. Joining me for this is Simon Elliott. So I think Simon will be familiar to lots of people who are watching. He joined JPMorgan last September as a client director in their investment trust team. Previously, he was at Winterflood Securities as head of research or head of investment trust research for 20 years, I believe. So today we're going to be talking, as I think you can tell from the holding slide we have up, about dividends and income and all those sorts of things. So Simon, thanks again for joining me. Perhaps to get started, why do dividends matter? I mean, what do investors need to know?
Well, first of all, David, thank you very much to you and Kepler for inviting me to speak to your audience today. I've got to be honest, this is the first time that JPMorgan have let me off the leash since I joined back in September. So this could be a first and last from me, but I'm very, very happy to talk about dividends, to be honest, because they really do matter, to answer your question. I mean, they're hugely, hugely important in the world of investment. I mean, obviously, lots of theory, lots of great quotes around dividends and income in general, but effectively, they're a chance for corporates to share their profits with their investors. And I think over and beyond that is that a number of academic studies have shown that over time, dividends or the income elements of your investment form a very large portion of the total return. So that's not to decry any capital gains that you may achieve over time, but certainly income is important. And I think another point that really people have picked up on increasingly in recent years is that the payment of dividends by corporates, so we're not talking about investment trusts now, I'm talking about companies in general, publicly listed companies, but the payment of dividends is often equated to good corporate governance. So it's those companies that have the kind of strongest levels of corporate governance around the world that you often see paying dividends, and certainly shareholders or minority shareholders, invariably investors in public listed companies place great value on them. But yeah, absolutely core to the kind of whole investment story.
Great. Okay. Well, just as an aside before we continue, for people who are watching, you have a Q&A section, or you should, on the side. So we will do Q&A at the end as well. But as we're going, if you have any questions and they're sort of relevant to the discussion, we'll try and weave them in. So yeah, so do feel free to ask any questions. But moving on, okay, I think if you've sort of touched on why they're important, I think if you look in the past, say, few years, one of the critiques I would say of the UK has always been that it's been quite a dull place to invest, not very innovative. There was you know, when the UK
dull is good. People like dull. Dull is the new way forward, I think, isn't it? That's the mantra that seems to be coming from the government at the moment.
Yeah, well, there you go. So, that's sort of what I want to touch on. So, if you look at the past, let's say 5 to 10 years, I think there's been a big movement, particularly in tech stocks, to sort of neglect paying out dividends. And there's, you know, I previously worked at a company with a lot of say software engineers, and it was very tech heavy. And the idea of paying dividends to them was, you know, ridiculous, and only bad, slow companies pay them. What should we make of that? I mean, I think, do you see any sort of trends around the world? Do you think the UK is going to become a more popular place again for dividend investors, given some of the macroeconomic changes we're seeing? What are your thoughts on that?
Yeah, no, it's a really good point. I mean, the UK equity market has been synonymous with dividends for forever, as long as I can remember. And the yield on UK equities at the moment is probably somewhere between about 3.5% and 4%. You know, we're going to come on and talk about investment trusts and how they look across the investment trust sector in just a moment. But if you look outside of the UK, I think there's a great dividend story across the world, frankly. I mean, certainly the US market, and again, that's been, that's really where you've seen a lot of these big technology companies. But even there, where there has been an emphasis more on buybacks than dividends, certainly there is a growing store with the latter. And I think given the changing market conditions that we've seen over the last year or so, I think to put a greater emphasis on dividends absolutely makes sense. So although you're all friends in the software sector may have been slightly dubious about the merits of dividends, I mean, you talk to investors and, capital growth is all very well, and, let's not underestimate the power of capital growth, i.e. share prices appreciating. But income, the dividend part of it, is hugely important. And as I made remarks about a few minutes ago, I mean, actually, academic studies will show that over time, for the long-term investors, and obviously a lot of investors in investment trusts are long-term by nature, but the dividends are doing a lot of the heavy lifting in terms of the total return that's been generated.
Yeah. Okay. Well, I mean, again, something to touch on there is the benefits of investing in investment trusts for dividends. Can you maybe talk a bit about just give an overview of why this sector is beneficial in particular for investors who are seeking income as opposed to perhaps alternatives?
Sorry, about investment just in general?
Yeah, so I suppose just dividends and the investment trust sector. So like, where are we today?
A snapshot of where we are today.
Yes,
where we are today is we've seen quite a big market sell-off. So I think we might just put that just to one side for the purposes of this conversation. But look, I mean, again, dividends and investment trusts go hand in hand. And just to kind of put some stats around that, I think that last week the AIC, which is the Association of Investment Companies, it's the industry body that keeps an eye and out for investment companies. But they made the point at their conference last week that £6.2 billion was returned to shareholders' investment trusts through dividends last year. So not an insubstantial amount of money. I mean, obviously, right at the outset, it's important to note that the decision to pay a dividend sits with the board of an investment trust. So it doesn't sit with people like JPMorgan or BlackRock or whoever it might be. It is the independent board that make the decision. The average yield across the sector, and again, this is as per the AIC, and if you put VCTs to one side, it's about 3.7%. So probably just a little bit higher than we're seeing from the UK market in general at the moment. But I think possibly more interesting that over the last 5 years, and again, these are stats I've just lifted from the AIC website this morning, that we've seen dividend growth equivalent to 6.1% per annum across the whole sector over the last 5 years. So obviously we're in a higher inflationary environment at the moment, but if you look at that 5-year period, that would be above inflation over that time. So again, if you look across the sector, there are probably about 320 or so investment trust companies or so, it depends exactly how you define the sector. But of those, over 80% will pay a dividend at the moment. And of those, probably about 140, so 46% or so will pay a dividend with a yield in today's market equivalent to about 4% or more. So there's a lot of dividend paying investment companies out there, a lot of attractive levels of yield.
Yeah. Okay. So we've had a couple of questions come in, and I think, well, 2 of them basically seem to be on what you could call enhanced dividends, so paying dividends from capital as opposed to being from revenue. Maybe I think it might be worth. I assume most people who are watching are familiar with what this is, but for those who aren't, maybe can you talk a bit about that process? And I think the general question, the 2 questions coming in are basically, what's your view on the subject in quite broad terms, positives and negatives, and I think we'll talk about it a bit more later, but maybe just start with those 2. Yeah.
So let's just define possibly to start with what we mean by an enhanced dividend. So, without boring people too much and giving them a history lesson, there was a tax change about 10 years or so, which meant that investment trust companies, with the permission of shareholders, so they need shareholder authority to do this, but they can pay out a portion of capital as income. So the idea being that you could pay an enhanced dividend, hence the expression. Now, we've seen a number of investment trust companies adopt those powers with shareholder approval. And even within the JPMorgan investment trust stable at the moment, we've got 6 investment trusts that have gone down this route. Probably overall in the sectors, probably about 30 or so, probably just over that have done this. So they will be in the minority overall. But what does it mean? If you take the example of JPMorgan Global Growth and Income, for instance, which was the first JPMorgan investment trust to adopt these powers, what it meant that's an investment trust that invests in global equities, and it probably has a portfolio yield, let's say around about 2% or so at the moment. So it would have paid a dividend before, but let's say it was in the region of between 1% and 2%, something of that nature. By converting an element of its capital, and when we talk about that, that's realized profits, so profits that it's realized over years, it can pay out equivalent to 4% of net assets every year. So it pays a quarterly dividend. It tells investors or shareholders at the start of its financial year exactly what it will pay out, and it pays it out on that quarterly basis. Now, there are variations on a theme. A number of investment trust companies, as I say, have adopted not dissimilar policies, but the mechanism will work in slightly different ways. They might reset that dividend every quarter, for instance. And there have been different reasons why investment trust companies have gone down this route. I think, broadly speaking, you could categorize them of seeking to widen their appeal. And I think it's probably fair to say that retail investors certainly seem to have responded well to investment trust companies that offer those enhanced rates of yield. And if you take the case of Global Growth and Income, so the JPMorgan Fund, I mean, at the time back in, I think it was 2016, when it adopted that policy, it was a reasonable size. So I'm going to say it was about £400 million market cap. It was trading on a double-digit discount. And as a result of that, or arguably to a greater or lesser extent, what it saw, it was re-rated on the back of it. That discount narrowed in. It also performed in NAV total return terms. And it meant that it could start issuing shares, and subsequently it's been involved in 2 mergers. So it merged with the Scottish Investment Trust and also JPMorgan Elliott, which the latter merger is to complete in the next few weeks, but it'll end up with about 1.7 billion of assets. So it's become a pretty decent sized vehicle as a result, and the enhanced dividend was very much a kind of key part in just getting that company re-rated and differentiating it from some of the other global equity investment trust companies. So that's been the real success story in that space. But for other investment trust companies, I mean, we've seen a number do it where, frankly, it's been very difficult to get yield. So we've seen some in the private equity subsector that have gone down this route. We've even seen a biotech company adopt a policy as well. And it's really, I think, for those investors that are looking for income, that have a kind of income component to their investment, it's kind of broadened their choice. So, turn the clock back. If you wanted private equity, well, that was about capital growth. By those investment trust companies, those private equity funds adopting this policy, it's put them on the radar of a broader range of investors, and similarly for biotech and so on and so forth.
Okay, I mean, do you think there are any risks around that? I mean, or also if we might see a change in their popularity. So I think if you look at some of the mergers or changes that have happened, or some of the trusts that have decided to follow this process, a lot of it seems more driven by partly driven by their investment process, right? So they want to be more growth-oriented investors that also have the ability to pay a dividend. It seems plausible that growth investing had a tough 12-month period. So do you think it will continue to be as popular as it has been going forward, given that possible changes there?
Yeah, no, it's a really good point. And I mean, ultimately, we'll see, I think, is the short answer. I mean, what I should have said, excuse me, when I was talking about the enhanced dividend, is that effectively it's the structure that's kind of doing the work on the dividend front. That, in the case of Global Growth and Income and other such investment trusts, is that they don't need to change their investment process. There's no tilt in the portfolio to income generating companies, if that makes sense. So what happens, as you rightly say, we're no longer in a kind of growth friendly environment. Market conditions are tough, as we alluded to earlier. And what happens then to those investment trusts with that policy? Well, they all rebase their dividends. So we'll probably come on to talk about the AIC dividend heroes, and that's the idea of those investment trust companies that got those consecutive years of dividend growth. And that's been a fantastic success story. The enhanced dividend That's not the way these investment trusts work. So they rebase their dividends, and they rebase them quarterly or annually, and invariably it's as a percentage of their net assets. That seems to be the most commonly used mechanism. But the idea being that obviously with market fluctuations and your capital base, your net assets go up and down, so too will your dividend. So the dividend paying profile of these investment trusts will look quite different to the aforementioned dividend heroes.
Yeah, so I think we've sort of leaped forward by looking at enhanced dividends as opposed to, I guess, dealing with the basics. So again, for I think a lot of people watching may be familiar with all of this stuff, but can you maybe talk through some of the structural benefits of investment trusts? I mean, why is it what about the way they're set up is positive or conducive to income investing?
Yeah, no, I think it's really important to tease these points out. I mean, the way I would look at it is I think there is a structural advantage with investment trusts and income generation or paying dividends. And I think there's kind of three areas. So the enhanced dividend element that we've just covered off. And that's a relatively small subset of the excuse me, investment trust universe. I think probably the second thing to note is those investment trust companies using their revenue reserves to provide greater dividend certainty. And I think it's probably worth drilling down on that in a moment. But the AIC dividend heroes would fall into that camp. And then I think the third clear structural advantage the investment trust companies have is the ability to access less liquid asset classes. So the kind of more specialist alternative assets. And there's been a huge growth in that area over the last 10 years or since the global financial crisis. And investment trust companies and that idea of a captive pool of capital play really well into providing access to that.
Yeah, okay, well, that actually leads on to, well, the mention of alternatives leads on to one of the questions which has come in. So I think part of the reason, if you look at the reason alternatives have become so popular is just because you had this period of very low rates, and this was sort of, and aside from being alternatives, you know, another source of income. Obviously, the past 12 months has changed things quite a lot because you suddenly have the ability to buy, let's say, bonds or let's say less risky assets that offer a more attractive yield than they have for quite a long period of time. So what do you think the effect of structurally higher interest rates will have on the demand for alternatives, specifically in the investment trust space? And do you think there are any managers will find it harder to invest at attractive enough rates of return to support high dividends over the medium term?
I mean, two very, very good questions. And so, I mean, the impact of high interest rates, you can already see that. You've already seen how the alternative income funds have been derated, particularly in the second half of last year. The repercussions will kind of roll on. But, you know, to take a step back on that, you know, following the global financial crisis and when we saw interest rates just go down to historically low levels, that arguably bonds became uninvestable or certainly gilts to a greater or lesser extent. So investors of all descriptions were forced to consider different asset classes, and investment companies were kind of part of the story. I mean, income was the kind of key investment theme for the best part of 10 years following the financial crisis. And as I mentioned, investment companies are a great way to provide exposure or access to those less liquid asset classes, often that offered very attractive yields. And you know, there's some great success stories. One only has to look about the renewable energy infrastructure funds. We saw a huge growth in that area. And obviously they offered attractive levels of income or attractive target dividends, but also they were ticking ESG boxes as well, and were part of a growth story. So that was certainly a big success. But I think it's worth bearing in mind that that type of vehicle, and there's a whole variety of asset classes as well. I mean, you just have to think about music royalties, leasing funds, social infrastructure. I think to a greater or lesser extent were being bought as bond proxies during that period of time. Now, to your point, when we've now find ourselves in a high interest rate environment where you don't actually have to take any risk to obtain an income of, say, 4% or so at the moment, then having that type of fund with a target yield of between 4 and 6%, and invariably that's how those products came to the market, suddenly becomes more difficult. And I think, as I mentioned, you can see that in the way that a number of those investment companies have been derated. I mean, there's a number of things going on there, but that's certainly an element of it. and the fact that the issuance market has become much more difficult. So after this incredible wave of IPOs, I think there was something like 160 IPOs across the investment company sector from 2010 through to 2021. We got to 2022 and we didn't see a single IPO, and obviously year to date that is true as well. So you drill down those 160 IPOs that we saw in that period of time preceding that, over 70% would have had a target dividend yield of 4% or more, and over 70% would have been offering access to those less liquid alternative asset classes. So there does appear to be a game change through that.
Okay, and the follow-up to that is, should investors be at all concerned about dividend cover for alternatives specifically? I think that's what they're asking. Or, sorry, in certain sectors, but I assume we're talking again about alternatives though. Yeah,
I mean, look, dividend cover is important for for any company, any investment company. It's always worth bearing in mind, and there have been a few instances recently of investment companies in more alternative asset income kind of subsectors that have got an issue on that front, and that's going to be quite tough, and boards will have to consider that carefully, and no doubt there are conversations underway with their shareholders in that regard. So yeah, look, dividend cover is hugely important, and I think there's quite a few moving parts here. I mean, if you look at some of those alternative income plays, I mean, an element of that has been, and I'm generalizing here, but an element has been when the model has been built, it's obviously been built on certain expectations with regard to the debt and the level of financing. Again, we're in a higher interest rate environment. Debt is clearly more expensive now. Now, for some of those companies that manage to lock in on a long-term basis, and this will be true for some of the kind of more plain vanilla long-only equity funds as well, that have got that put some long-term financing in place. But particularly on the alternative side, where gearing is part of the structure part of the model, the higher rates will have implications to dividend cover, and therefore where dividends go in future. But it's kind of hard to generalize, because you could look at the renewable energy infrastructure sector. Sorry, I'm just going to click something here because I've got slightly alarming. I was about to be booted off by my machine. That would have been a dramatic moment in the webinar. Let's avoid that one. But yeah, just to kind of wrap up on this, the financing costs will have the implications, but you've really got to do your homework. It will change massively from investment company to investment company and by subsector to subsector. Okay, well, I sort of, again, we've gone off on a bit of a tangent. So I think the original point here was actually to talk about the AIC's dividend heroes. So what should investors know about that? Well, I'm sure some of the people on the call will be very familiar with the dividend heroes, and in some ways it's the kind of the long-standing. We talk about the three structural advantages. This is the kind of one that's been in place, and just to remind people or tell people less familiar with the concept, it's this idea that investment trust companies, a number of investment trust companies, have been able to build these incredible records of consecutive years dividend growth. And funnily enough, the AIC published their updated list, I think just last week actually, and I think they had 18 dividend heroes on that list. So they're investment trust companies with 20 years or 20 consecutive years or more dividend growth, of which there were 8 that had achieved 50 years or more, which is quite impressive. And one of JPMorgan's investment trusts, so JPMorgan Claver House, hit the 50-year threshold. So you can imagine there was lots of delight across the floor here at JPMorgan. Right. We're all very excited by that. But of course, to remind people, it is a board decision. It's not down to the fund management group exactly how the dividend works out. But it is very impressive, and I think we should just dwell on it for a moment, because it is a reflection of how investment trust companies are set up. This idea that under the rules, you can only retain 15% of your income in any financial year. You have to pay out a dividend basically to retain your investment trust status if you kind of get into that category. And what that's meant that over the years, investment trust companies have been able to build up revenue reserves, and it's these revenue reserves that really kind of come into their own on those rainy days. So when The most recent case, obviously 2020, during that the dreadful year of the pandemic, when markets were all over the place, and I think we saw something like a 46% cut in dividend levels across the whole UK market. So it really was carnage in terms of dividends. Now, obviously, there were some investment trusts that were impacted by that. And even if you look at the AIC dividend heroes, we did see, I think there were 4 fallen heroes during that particular year. 3 through corporate activity. There were a couple of mergers and a change of manager, and 1 just dropped off the list. But the majority use their revenue reserves, and this is true for a longer list of investment trusts as well, to kind of maintain their dividend levels, or even in the case of the dividend heroes, continue to grow them, despite the fact that we did see dividend falls, not just in the UK market, of course, but across the world. So that really is a reflection of the advantage. And just to, not wishing to knock open-ended funds too much, because people not very far away from me are busy trying to promote those particular products, but it is an advantage of investment trusts over open-ended funds who, in the majority of cases, they pay out what they receive in any particular year. So, we're talking about enhanced dividends and the idea that dividends or income might go up and down. Well, that's kind of the case for open-ended funds, frankly. And that's part and parcel of that particular structure.
Yeah. So I mean, one of the comments that's come in, I suppose, is expressing some skepticism of the AIC heroes. And I suppose the question is basically, is there a danger that it becomes a useful marketing tool but actually doesn't tell you much about the quality or their performance of those trusts? So is there a possibility, I suppose, can that become a distraction? Is it just a static list of trusts that have been dividend payers and it doesn't actually tell you that much about the quality of the funds or their performance?
Well, just to kind of unbundle that a little bit, is it a great marketing tool? Yes, of course it is. To be able to say you're an AIC dividend hero, of course, it's a great reason why people like me bang on about it. And it's worth saying that there are the rising heroes as well. So these are those investment trust companies that haven't quite made the 20-year level, but are somewhere between 10 and 20, and there's a whole bunch of those. So the list is not static, just to be very, very clear. It gets refreshed every year intentionally by the AIC. And as I mentioned earlier, we have seen some fallen heroes. So 2020, unsurprisingly, given those market conditions, we did see 4 names disappear off the list. So it's not static. To the point on performance, yeah, of course, it's only one part of the story. It's just focused on dividends, and there might be investment trust companies on the dividend hero list that, frankly, whose performance records don't stand up compared with their peers or their benchmark or whatever it might be. So I wouldn't just take that hero status and assume that everything is golden. As always, do your homework, I think, is a very good piece of advice.
Okay, there you go. To the person asking that. So I mean, to sort of follow up on that, I think we wanted to talk a bit about some of the tools or things you can use actually on the AIC website that can sort of help income investors. Do you want to talk through those tools?
Yeah, I mean, it's a question that in my old guise as an analyst often came up in terms of, well, how can I find out more information? And I mean, there are a number of websites now free to use where you can actually, to this point about doing your homework, I think it's hugely important. You can go and delve into, obviously, investment houses like JPMorgan. We have our lovely website, and you can look and see where we are. And there's lots of information about income readily available. If you want to kind of look across the whole sector, then the AIC, I would suggest, is probably a very good starting point. And one of the things I'd point people's attentions to is that they do have this rather cool tool, in my view. It would be a little bit sad, but it's called the AIC Dividend Finder tool. And the idea is that you put in your portfolio of investment trust companies, and it tells you kind of month by month when you would expect your dividends to be paid. So as I mentioned, dividends can be paid on an annual, quarterly, monthly. There are a couple of investment trust companies that do pay monthly dividends. But by using this tool, you can kind of put in your portfolio, and it will map out exactly when you would expect to get your income in any given year. So yeah, have fun with that, I think, is probably the best piece of advice.
Okay. We've got another question on, again, around, there's quite a few around interest rates. So I think you've sort of touched on this already, but it might be worth revisiting, is around in a higher for longer environment, what happens to renewables and infrastructure? and specifically around do you think NAVs are going to hold up? I don't know how much you can actually say about this, but so feel free to say if you can't. Are there income streams index linked sufficiently? I suppose that's in reference to some kind of inflation index.
Yeah, I mean, okay, there's a few bits and pieces there. I mean, what I would say in particular on the infrastructure side and the renewable is that invariably those type of investment companies will publish their sensitivity to interest rate movements, so rises and falls. So again, you probably need to do your homework a little bit, but you could probably find, I would suspect, and I haven't looked at it for probably about 6 months or so now, but you can see that degree of sensitivity. And the person who asked the question is absolutely right. Clearly, there is a sensitivity to interest rate movements for those type of funds. It will have an impact on their NAV. However, that said, there are other elements that build up the valuation. So, in the case of renewable energy, unsurprisingly, they are quite sensitive to energy prices. Intuitively, of course, that makes sense. So there are a number of different, moving parts. But yes, they will have an implication on their valuations. I mean, in terms of inflation linkage, I mean, just to kind of take that a step back, I think, some investment companies will have a direct inflation linkage, or if not, they will say we try to grow our dividend at least in line with inflation. Now, clearly, we're in a higher inflationary environment, and frankly, that's going to be quite difficult to do, I would suggest, given that let's call inflation in the UK at 10% or so at the moment. So I would suggest that most investment companies, even those, and this is not just on alternative, this goes across the piece, those that have ambition to grow inflation in the short term at least, might struggle with kind of meeting that objective. They would say that actually they look at it over a longer time period, and historically they have been able to achieve that, though clearly in a lot lower inflationary environment. But that's certainly something to watch. I mean, I think I mentioned earlier the stat that the AIC had on that annual dividend growth across the whole sector over the last 5 years, and I think the number was 6% or so, 6.1% to be precise, and that's obviously quite impressive. But what is it going to be going forward? Because it's all very well talking about dividends and income and all the rest of it, but if we continue to see higher rates of inflation than we've been used to over the last 10 years, then obviously in real terms at least, those dividends will look a little bit less attractive. But that's something that will become clearer, I think, as the next year goes on.
Okay, well, I mean, so one of the things we touched on quite a lot so far was on enhanced dividends, and I think if you look in the past, so one of the things that has changed with it was you used to have split capital investment trust. So again, for someone, you're laughing as I say this, so I don't know what that means. I don't know if that's a good or a bad sign. Generally these would say merge into one trust. So you might have an income, basically have one trust. It would have two. I'm just explaining for someone who's watching who isn't familiar. So you have one share class, which might pay a dividend, and then one which doesn't. It's more for growth investors. So do you think it's plausible, given that those have fallen off in popularity in the past few years, that they actually might make some sort of a comeback, or they may become more popular again, as if appetite for dividend returns, or sort of more, I suppose, income investing becomes a bit more popular again? That's the right way to phrase it.
Could we see? So I'm going to kind of just surmise. I mean, could we see a revival in split capital investment trust because we are in a higher interest rate environment? Might be.
Yeah, I think that's probably the best way.
Might be another way to kind of frame that question. It's possible. I mean, without kind of getting into the whole kind of split cap thing, because it's a bit. I mean, it was something that was very prevalent over 20 years ago. Obviously, not so much at the moment. And one of the reasons, certainly in the last 10 years, is the maths doesn't quite work, because in a low interest rate environment, take zero dividend preference shares, for instance. I mean, with debt so cheap, you just couldn't justify putting a what's called a ZDP into the kind of capital structure. Does that change? Possibly. I still, and it's something to watch. I mean, I think it's very early days, but something to keep an eye on. I mean, again, with zero dividend preference shares, one of the reasons why people quite like them was because you had the kind of, if it all worked out, you had the return profile from the outset all kind of mapped out, and it was a kind of capital gain. I mean, given the changes that we're now seeing in capital gains tax, arguably ZDPs might not look quite so attractive, possibly. But I think in terms of, does an era of higher interest rates lead to the revival of split capital funds? I think it's too soon to say. And even if we did see one or two popping up, I would imagine there would be a relatively small number across the investment trust space.
Okay. Well, one of the things that I sort of mentioned earlier at the start of the discussion was around, I suppose, I think the UK has always been seen as definitely in the past, say, 20 years, as the sort of income investors, a good place to go for an income investor, I suppose. And I think we are seeing some changes, particularly in Asia. So I think if you look at some of the changes since in Japan, since Abe became prime minister or was prime minister, and there's a big focus on, I suppose, delivering returns for shareholders, and that has had quite a meaningful impact. Definitely for some, if I think of, say, CCJI as one investment trust that seems to have really tried to set up to take advantage of that. But I think that's also true for the region as a whole. I know JPMorgan also has a Asia investment trust. So do you think that's going to become another a region, I suppose, for dividend growth as shareholder returns becomes a bigger part of corporate life there?
Yeah, look, I think there's a great story to be told about dividend growth on a global scale, and certainly the stats that I've seen for 2022, it was a very impressive level of growth in dividends for global equities. Now, obviously, you could argue that was a bit of a bounce back and kind of post-COVID. I think most experts would argue that their expectations for dividend growth are lower in 2023 because of where we find ourselves for the reasons we've already discussed. I mean, in terms of different regions, I mean, in the JPMorgan stable, it's worth noting that our China fund, our Asia fund, the Jap small cap fund, that all offer yield, they're all enhanced dividend plays. So those portfolios are not tilted towards those higher dividend paying companies. They're effectively allowed to invest where they want, and invariably have a bit more of a kind of core growth bias. And then the kind of pickup in the yield comes through the structure. One fund that we do, or one trust that we do have in the JPM stable, is the Global Emerging Markets Income Fund. And that's very much trying to pay a kind of covered dividend by investing exactly in those companies. So obviously Asia gets picked up as part of that, though clearly it's a broader mandate. And that particular investment trust has been around, I'm going to say about 12 years now, probably 12, 13 years. And it has seen that kind of growth. I mean, one of the things that's worth noting about dividends, particularly from Asia, is that payout ratios are far more common. So, to your point about the UK market, I mean, people in the UK like that kind of steady progression in dividends wherever possible. And obviously we see that reflected in the investment trust world. Whereas other areas of the world, and Asia would be a good example of this, invariably have a payout ratio. So in other words, they make their money in any given year, and a percentage gets returned to shareholders as a dividend. So obviously that will kind of fluctuate in time, but that doesn't seem to be a particular issue for them.
Okay. Well, to follow up on that, you've talked a bit about how some of the JPMorgan trusts structure things around dividends. Can you talk about further about that? I mean, what's the position of the JPMorgan investment trust stable? How do you?
I feel like we're doing the advert now for JPMorgan.
Yeah.
We've got to that point. People will be clicking off in their droves, but. I'm going to give you some stats without any form of apology whatsoever. I'm going to give you some stats. So we have about 20 or so investment trusts in the JPMorgan stable, of which 17 currently pay a dividend. I think we talked about 6 find themselves in the enhanced dividend camp. They're all structured in a slightly different way, but effectively 4% is the magic number. In addition to that, we've got Claverhouse. Again, I mentioned that, one of the AIC dividend heroes, hit its 50th consecutive year of dividend growth. But we've also got a number of investment trust companies that are paying covered dividends and have good long-term records. So the Mercantile Investment Trust, which the yield at the moment is about 3.4%. So that's invested in mid and small cap UK equities. We've also got 2 other investment trusts in the UK space in that kind of mid and small cap area, and they both pay. So the mid cap fund, the JPMorgan smaller companies, also offering an attractive level of yields. And for those people who don't necessarily want equity exposure. We launched the Global Core Real Assets, JPMorgan Global Core Real. It's a bit of a mouthful actually, but we call it JARA, and the yield on that is about 4.8% at the moment. As the name would suggest, that's real assets, but on a kind of global basis, really kind of tapping into the JPMorgan machine in that regard. So, overall dividends and income, although there are 2 or 3 exceptions within the stable, most are paying a dividend.
Okay, well, I mean, maybe we can wrap up and then take a couple more questions before you head off. I know you're very busy. So I suppose for anyone watching this, what do you think are the key takeaways for investment trust as a source of income, or investment trust and dividends? What are the key things that people should keep in mind? And actually, just on that point, I think particularly any risks that may have changed in the past, let's say 12 months, mainly as a result of interest rates rising.
Yeah. Well, look, I mean, hopefully as come across over the last 40 minutes or so, I mean, investment companies are a rich source of income. I mean, I mentioned the figure 6.2 billion paid out last year as per the AIC. And investment trusts or investment companies have a number of structural advantages when it comes to generating dividends. So the use of revenue reserves, the access to illiquid asset classes, and the ability to pay enhanced dividends. And I don't think any of that changes anytime soon. Clearly, we're in a higher interest rate environment, and that does have repercussions for investment trust companies. And to the point I made earlier, and hopefully I didn't come across being entirely facetious, but it does pay to do your homework and to understand where the income is being generated from with the various investment trust companies and where the sensitivities are, because there are no guarantees in this life as we know it, and certainly with regard to investment trust companies' dividends, you would hope, and it's interesting when you see the rhetoric or the wording from the chairs of those investment trust companies that find themselves dividend heroes. They're very proud of the fact that they've achieved that record and they hope to continue it, but at the same time they can't guarantee, and things do change. So just to be very careful on that front. But I think overall the kind of the story for equities at least is very strong in terms of global dividend growth. I don't think that's going to change anytime soon.
Okay, thanks very much for that. We'll finish off with a couple of questions. So one is just around, well, it's around discounts in the private equity sector. So I think this seems to be a perennial question of this event so far. I would actually apply this also to some, say, parts of UK commercial property. I think basically in general, if you look at the past 12 months, there's lots of trusts across a few sectors where discounts have widened out massively, and in some instances it's understandable why that's the case. I think the question is basically, do you think that's been overdone in any instances? I mean, I'm not sure how free you want to answer this, but any thoughts around very wide discounts in some sectors where that has happened?
Yeah, I will try to answer that, but I will obviously be quite careful exactly what I say. Look, I mean, the question is entirely right. We've seen private equity, and we've seen commercial property derated, and illiquid asset classes overall derated over the last 6 to 9 months. I mean, private equity in particular, I think is a very interesting asset class. It has invariably traded at a wider discount for a number of years now than the rest of the investment company sector. We're now seeing discount levels of between 40 and 50%. I mean, what I would say historically is that there have been periods in the market cycle when we've seen listed private equity derated on that basis. So people remember the early noughties after the tech boom, also after the global financial crisis, not dissimilar. And we did see those, not dissimilar levels of derating at that time, amid people questioning what the genuine underlying valuations are and all the rest of it. I mean, it is obviously a long-term asset class. I think one of the questions that people might want to ask is, the sources of financing for those type, not the actual investment trust companies themselves, but for the portfolio companies that they have. Are they going to be able to continue to receive financing funding? Do they need financing to kind of see them through this difficult period? And obviously the news with regard to the Silicon Valley Bank kind of plays into that. So, without wishing to dodge the question entirely, I think it's something that you have to take probably a long-term view on, and also you have to do your homework with regard to exactly what you're exposed to.
Okay, well, maybe to finish off, we can have a more marketing-oriented question. So it's a question on, it says, Jara, where can we find more details about the underlying investments? I mean, I assume the fact sheet, but maybe you have some other thoughts there?
No, I mean, head to the website. I think it's probably the best starting place. I mean, you will find the fact sheet there. You'll find information about the investment trust company. I think the annual report is actually quite useful in that regard, because it is a range of different asset classes make up that particular portfolio. So yeah, hopefully all the information is there, and I'm sure if there's something that you can't find, there'll be probably a helpful email address, and you can email one of my colleagues. I'll only be too happy to help.
Fantastic. Well, you also have someone saying it's very good to hear your insights again after such a long time from the IT podcast, the Investment Trust podcast. So it's, he says very good to hear from you again. But the podcast, obviously, the #2 investment trust podcast after the Kepler Trust Intelligence podcast. So okay, great. Well, I think that's all we've got time for. So thank you, Simon, very much. This was fantastic. And yeah, hopefully we can chat again at some point in the future.
That's great. Thanks, David. All the best.
Thanks everyone for watching as well.